Ladies and gentlemen, good day and welcome to the Tatva Chintan Pharma Chem Limited Q2 FY24 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanjesh Jain from ICICI Securities. Thank you and over to you, sir.
Thanks, Siva. Good evening, everyone. Thank you for joining on for Tatva Chintan Pharma Chem Limited Q2 FY24 results conference call. We have Tatva Chintan management on the call, represented by Mr. Chintan Shah, Managing Director, Mr. Ashok Botra, Chief Financial Officer. I would like to invite Mr. Dinesh Sudani, GM Finance, to initiate with his opening remarks, post which we will have opening remarks from MD and then we will move to the Q&A session. Over to you, Dinesh.
Thank you, Sanjay ji. Good evening, everyone. On behalf of the management, I am pleased to welcome all of you to Tatva Chintan's earnings call to discuss financial results for the quarter and half year ended September 2023. Please note that a copy of all our disclosures are available in the investor section of our website as well as on the stock exchanges. Anything discussed on this call which reflects our outlook for the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risk that the company faces. Now I shall hand over the call to our Managing Director, Mr. Chintan Shah, for his opening remarks. Over to you, sir.
Thank you, Dinesh. Good evening, everyone, and welcome again to Tatva Chintan's earnings conference call to discuss Q2 FY24 and H1 FY24 results and performance. The results have been uploaded on the stock exchange. Hope you had a chance to review the same. In August 23, the company raised 200 crores by way of QIP. The funds raised will be utilized towards repayment in full or in part of certain outstanding borrowing availed by the company and for the general corporate purpose. As on 31st July, our utilized working capital limits were to an extent of 165 crores, which reduced to 52.09 crores as on 30th September, which have further reduced to nearly 2 crores as on 31st October 23. The chemical industry continues to face several challenges. The demand has continued to remain low due to ongoing efforts of industry to reduce inventories to realistic levels. The anticipated increase in product pricing also remained short-lived due to low-cost products being made available by Chinese companies. During Q2 FY24, we witnessed few orders getting postponed. With the upcoming financial year end for our global customers, we expect a similar situation to continue until December 23. With the new geopolitical situation in the Middle East, the uncertainties continues to remain high. Until now, we have not felt any major implication of this event. Despite of these challenges, your company has performed reasonably well. The diversified portfolio of products has helped us sustain well during these difficult times. During Q2 FY24, the company reported revenue from operations of 967 million, a growth of 7% year-on-year. EBITDA during the quarter was at 202 million, a growth of 81% year-on-year. EBITDA margins were at 20.9% versus 12.4% in Q2 FY23. During H1 FY24, the company reported revenue for operations of 2110 million, a growth of 18% year-on-year. EBITDA during the half year end was at 416 million, a growth of 58% year-on-year. EBITDA margins were at 19.7% versus 14.8% in H1. Now I shall share updates and key developments on each of our product categories. PTCs have registered quarterly revenue of 232 million and half-yearly revenue of 547 million, contributing about 26% of revenue from operations and a degrowth of 25% year-on-year basis. PTC product category has been most impacted in terms of demand, leading to order postponements. This product category is facing most challenging times in terms of competition as well. Despite these challenges, your company has maintained all its customers in global markets. Also, due to transparent pricing policy, we have been fairly successful in maintaining our margins. We expect similar situation in terms of demand to continue until March 2024. Electrolyte salts have registered a quarterly revenue of 12 million and a half-yearly revenue of 25 million, contributing nearly 1% of revenue and a degrowth of 79% year-on-year basis. Our existing large customer has completed their plant debottlenecking activities. They have resumed procurement of the products, though at a slow pace, as they are also parallelly consuming the piled up inventory. At another large potential customer, their project is moving at a good pace towards final commercialization. We maintain that FY25 will be the key turning point in this segment and remain certain of exponential growth in this segment over the next 3 years. Pharma and agro intermediates and specialty chemicals registered a quarterly revenue of 288 million and a half-yearly revenue of 598 million, contributing about 28% of the revenue and a degrowth of 22% year-on-year basis. Despite of tough times, most of our businesses within the pharma and agro intermediate space has continued without any significant major impact. During the quarter, lot of activities and developments took place in this product category. We successfully delivered 2 pharmaceutical intermediates from plant scale for final validation. In a short time, we expect to scale up the third intermediate to pilot levels. We expect commercialization of all these 3 products by early 2025. We also successfully delivered 1 agro intermediate for the plant scale approval, which is running successfully at the customer's end. We completed production of a large potential agro intermediate. The validation plan for this intermediate is slightly postponed until January 2024, and commercialization is moved to half year of FY25, H2 FY25. Pilot scale approval of the third intermediate has been achieved. We are awaiting the plant scale equipment installation to commence production for final validation. We expect to receive this equipment within Q3 FY24. Our strategy to work on alternative chemistry and offering greener options to customers have rewarded us eventually. With our success to implement these chemistries on plant scale, the morale and confidence of our team at Tatva Chintan is high. The launchpad of growth for this product category is ready, and we expect this segment to take off. SDS registered quarterly revenue of 428 million and half-yearly revenue of 924 million, contributing about 44% of the revenue in H1 FY23 and a growth of 487% year-on-year. The commercial vehicle sales have been improving steadily, except for China market, where the improvement has been much slower than anticipated. The de-inventorization by catalyst producers has also kept the demand on lower side. The sentiments within these segments have been improving steadily. Within this product category, we have few exciting developments to share. We got formally approved on multiple product applications with a new large potential customer. We expect commercialization to begin from Q4 FY24 and gradually expect to scale up. The validation for few products or applications with our existing large customer is progressing well and nearing completion, which will provide us with much larger business opportunity in the next financial year. With our newly added customer, the business has been growing steadily and level of confidence is gradually building up. We expect FY25 to see a significant growth in revenue in this product category. Flame retardants. Manufacturing of flame retardants have been still kept on hold due to market conditions prevailing within the segment. With the new geopolitical situation in Middle East, we foresee few things might change positively for us in this product category. During the quarter, we have received formal approval from a very important customer in the Western Hemisphere. It has taken us nearly 15 months to get this approval. We expect slow commercial production to begin in Q4. Our development work on ultra-high purity chemicals for electronic applications in this category is progressing very steadily. Within H1 FY24, the overall headcount has increased by 116 people. These recruitments were largely on account of newly commissioned facility and also partly towards enhancing the R&D capabilities. During H1 FY24, the employee expense has increased by 44% from nearly 18 crores to rupees 26 crores. During the quarter, the Dahej SEZ facility has moved to utilization of natural gas as a fuel. This is a slightly expensive option, but an environmentally cleaner option. During H1 FY24, the power and fuel cost has increased by 50% from rupees 12 crores to rupees 18 crores. From the high value inventory of March 23, we consumed only about 11% of that inventory during the current quarter. Most of the production done during the quarter was using freshly procured raw materials, leading to margin normalizations. We anticipate increase in business volumes over next couple of quarters. The overheads will also start getting absorbed uniformly, translating into better and more realistic margins. To summarize, the chemical industry is definitely going through a never seen before situation, and the pain is yet not completely over. However, Tatva Chintan is well placed as we are diversified across product categories and our products find application in varied end industries as well as across geographies. Hence, an impact in demand in one product category is being offset by subsequent demand in another product category. To conclude, we remain committed and assure you that we are working hard in developing new products using latest technologies to ensure that we can continuously provide good products and better solutions to our customers. With this, I hand over the call to Mr. Ashok Bothra, our Chief Financial Officer for the quarters and the half year's financial highlights.
Thank you, sir, and good evening to everyone present on our call today. The financial highlights for the quarter and half year are as below. Revenue from operation was at 967 million versus 901 million in Q2 FY23. That is a growth of 7% on YOY basis. Other income during the quarter was at 8 million, a decline of 61% YOY basis. EBITDA was at 202 million versus 112 million in Q2 FY23, a growth of 81% YOY basis. EBITDA margin increased by 849 bps YOY basis to 20.90% in Q2 FY24 due to optimization of internal cost measure as reflected in decline in COGS and other expenses by 9.63% and 3.26% YOY basis respectively. However, the impact was offset by increase in employee expenses by 4.3%. PAT was at 78 million versus 71 million in Q2 FY23, a growth of 9% YOY basis. PAT margin was 8.05% versus 7.89% in Q2 FY23. The finance cost during the quarter increased by 72%. Going forward, the finance cost will substantially decline on account of reduction in working capital utilization from QIP proceeds. During Q2 FY24, exports stood at 671 million, comprising 69% of the revenue from operation. The company has a customer base spanning over 25 countries, including USA, UK, China, Germany, Japan. Out of net IPO proceeds of 2072.81 million, 2027 million have been utilized so far. That is 98% of the funds have been utilized till 30th September 23. During the quarter, 25 million was utilized. Regarding QIP placement of 2,000 million, 1840 million have been utilized so far. That is 95% of the funds have been utilized till 30th September 23. That concludes an update on financial highlights of our company. I shall now request the moderator to open the floor for question and answer session.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Mr. Sudarshan Padmanabhan from JM Financial. Please go ahead, sir.
Yeah, thank you for taking my question. Am I audible?
Yes, sir.
Yeah. So my question is to understand now that the first half is over and we have seen, the SDA sales between 40 to 45 crores. So the new capacity is in place.
There is some background noise. Can you check that, please?
Sudarshan, sir, the background noise is from your line, sir.
Can you hear me now? Is the background noise better?
Yes, sir. Please go ahead.
So the first half we have done an average of between 40 to 45 crores a quarter on the SDA side. The new capacity is in place and, we talked about onboarding new customers, which will give a fillip in terms of growth in the second half. We did talk about a fair amount of traction that could happen in the second half and FY25. So if you can give a little bit more color about, how do we see the next couple of quarters? Is the onboarding process giving us that kind of a confidence in terms of growth? Or is there any change in the outlook on that perspective?
You have asked this question for SDA?
Yes, sir. Yes, sir. SDA.
Yeah. So with the formal approval now in place, which we just received 3 or 4 days back within this week itself. And with this formal approval in place, this opens up door with one of the largest potential customers globally. Of course, you can understand the first year. So I am saying first year in terms of calendar year 24 would not be a big start. So this should begin. We expect the first commercialization to begin in February of 2024 and ramping up potentially from the second half of 24. So July onwards is when we will start realizing the full potential of this customer, gradually increasing. Also, we expect a very decent rise in terms of volumes from our existing largest customer, where we are in an approval stage, nearly completed, almost successful so far. So this gives us opportunity for an application into automotive, but also a large application into the refining catalyst side. So this opens up new doors for us to increase the business volumes with our existing customer as well. And the last customer which we had added in last few months. So this customer, we have seen gradual increase in business volumes happening there, and we expect FY25 to see significant rise in volumes from this customer as well. So if I say, let us say, significantly we will see the volumes to rise from April of 2024. And I expect FY25 to be really exciting in terms of SDA volumes, and we expect at least 80 to 100% growth in this segment in terms of value.
Sure, sir. And in this
we have done some significant work in terms of optimizing certain values where we are giving them benefits in terms of indigenized production of certain key raw materials, which we were largely dependent on imports. So this gives them a coverage in terms of supply of having a non-Chinese origin product completely. So this is where we are bringing in value for both customers, our existing and this large new potential customer. So we intend to backward integrate this, and that is where the qualification is right now going on. So we successfully did this on plant scale, supplied them the product, and now that is under final stages of qualification. So giving them an option of having an independent of China supply chain, which is going well with both these customers, and we expect to have very decent volumes from them from next financial year.
And sir, in this context, I mean, we are seeing scale up happening in the PASE, that is, and BFR. I mean, are we still sticking to the guidance that we had started with for the FY25 as far as the top line is concerned?
More or less, yes. The answer to that is definitely yes. So, and we should see at least a growth of anywhere between 70 to 100% in terms of growth in revenues for next financial year.
I'm talking about FY24. Yes, sir.
I'm saying FY24 we see nearly flattish growth, maybe 5 to 7% in terms of revenue growth is what we see in terms of top line. In terms of bottom line, we will see a quite decent growth. So we expect to end with an EBITDA anywhere close to about 100 CR.
Sure, sir. And sir, my second question is on the BFR side. With this Israel-Hamas war happening, I mean, do we see an opportunity for us? I mean, in terms of on the ground, are we hearing clients coming up and talking to us, in terms of advancing, the supplies at an earlier stage? Do we see things to relatively be much better on this, part of the business?
Not really. The reason, so except for this new customer where we have now got qualified, they are very anxious to hand over at least 30% of their demands to us. But apart from that, in the Eastern Hemisphere, we are not seeing that kind of an encouraging feedback. Primarily, still seems there's a lot of inventory, and also the demands within that polymer sector is really, really low. So that interest levels in doing something new is really missing. So that is the reason why we are not kicking off the commercial production so far. We are already all set. So with this new customer coming in and giving us assured volume is when we intend to start production of BFRs. So as far as the PASE segment is concerned, I think all the hard work has paid off commercialization. So any skeptical points about whether we'll be successful in scaling up this new technology or the processes at a larger scale. So all those things we have overcome. We have successfully delivered product, produced them on plant scale, and now we are just waiting for the business to start. So we expect Q1 or Q2 of next year to actually see a strong ramp up in the PASE segment in terms of product offtake on the ag side. And on the pharma side, we will see that happening in early 2025.
But going by your commentary, progressively, we should start seeing the benefit in the second half. I mean, the second half should be better than the first half, and FY25 should be significantly better than FY24.
Not on the agro side, because agro side, these product one has been delivered, which is right now under qualification. The second product we will deliver in between 7th and 15th of January as they have scheduled it. So we are sitting on the product right now. We completed the production in October. We are sitting on that product, but they want us to deliver not before December. So they don't want to see it in their inventory. So we'll deliver it in first or second week of January. And then, so this actually had to happen in end of September. But then they wanted to postpone it because they took a longer shutdown in the plant. So typically they have a plant shutdown which runs for almost 2 weeks, which actually got extended to 6 weeks. So they did not want to take up this product for qualification within this quarter, but which is now scheduled for the next quarter. So this again postpones your commercialization by 1 quarter more. So this is what has happened. So we expect that commercialization to happen in May or June of next year. And this is a significantly large product for us. So both one which is right now under qualification and the second one which we will now deliver in January, both put together can give us a significant impact in terms of top line for the PASC segment.
So one question before I join back the queue is on the tax rate. I mean, where do we see the tax rate, coming down? Because as the scale increases from the new plant, I would assume that the tax rate would basically get absorbed as well. So, I mean, can you show some color on that, sir?
Let me pass on to Dineshji on this.
So right now we have a capex of around 250 crores in this year. So effectively we are sitting on the deferred tax liability. So that's why this year we are likely to having the tax rate of around 29 to 30% effective tax rate.
Yeah, and that should come down drastically, once this deferred tax basically gets completely utilized.
Maybe in the next year, maybe financial year 25, it will be drastically down.
Yeah. Sure, sir. Thanks a lot. I'll join back the queue.
So, Padmasambhanji, even in, so we have this 50% tax break for the Dahej plant running for next 5 years. So right now we are in the second year of that. So still 3 more years for a 50% tax break at Dahej. So once this depreciation gets consumed, then we will see an impact of lower taxation provisions happening in the books. Potentially FY25 should see that.
Sure, sir. Thanks a lot.
Thank you. We take the next question from the line of Mr. Ajit Motwani from Diamond Asia. Please go ahead, sir.
Good evening, sir. So just wanted to understand, firstly on SDC as a market, in tonnage terms or value terms, where exactly is the size of the market, let's say this calendar year versus last? Which geographies are lower or higher? And second question is, you talked about you being, taking a new client on SDCs and, because of a new process chemistry. So would it also mean that your ability to garner a significantly higher market share than what was it earlier? If you can throw some light on these two aspects.
Sorry, can you please repeat this again?
So first question is the size of the SDC market. You said it's still lower, globally. Second is you said that you've got a new client in this because of a new process chemistry that you developed and have passed on the benefits. So does this mean that you will be able to garner a bigger market share as and when the market revives?
Right. So basically this large customer which we now have been approved on. So this is an existing customer where we had no presence. So this is definitely acquiring the market share in a bigger way. And this is coming because of adopting this concept of providing them a solution to have a security of supply by having a non-Chinese origin supply chain. So this concept has paid off. So the hard work which we did in developing this complex chemistry at our plant has really moved the customer to get us into the supply chain. So this is definitely nothing new that we are doing for them. This is their existing product which they are buying from the competition, and where we will see a significant contribution coming from Tatva from next financial year. So this of course opens up doors for us for a larger market share. Again with my existing customer. So in one of the product it is exactly the similar thing. So it's a different product though. And this product also it is way of backward integration that we are providing them some significant benefits in terms of security of supply, but not only that, but also in terms of pricing. because this also gives us some distinct advantage in controlling the cost of the product, of the final product, by getting into backward integration of raw material. So it's a win-win situation for us as well as for the customer. So this is again an existing product for them where we are just having a minority supply situation, which we intend to convert it into a majority supplier for them once this product is qualified. So this again will happen in next financial year, going from April.
Good. And these benefits, so net our margins should be better off even after passing on some benefits to the client on these two things.
We are nearly passing on 70% of the benefits to them. So yes, our margins will also slightly increase. But if you consider the raw material cost is not significantly, so there are multiple raw materials and multiple stages through which this product goes through to sell a final SDA. And if you see the overall raw material consumption in SDA is anywhere between in a range of about 40 to 45%. So when you say there's a benefit in this, it's not going to be a very huge number in terms of percentages compared to the final selling price of the product. But still there will be some expansion in terms of margins for those particular products.
And in terms of the market size, SDAs, have they, how have they, are they back to what they were, or they lower?
Still they are not, we earlier we had two large customers, in fact 3. So currently most of the volumes are coming only from one single customer and the newly added 4th customer. The second and third customer were dead so far. Second customer still continues to remain almost at 0 volumes, and we don't expect them to resume buying at least until February. And the third customer has now come back to life, and they have started placing smaller volume orders, but at least they are back to life. So still the market is not back to normal scenario, but it is gradually moving towards that. So we can see that the discussions that the floor of discussion has been opened up, multiple inquiries about timing of deliveries, lead times, and all those things have started to happen. So we see that the life is coming back for these two customers as well. But so still the market is not really at the same levels what it was pre-COVID times, just the post-COVID times, but we are expecting this to come back to life within a very short span of time. So we see a lot of movement and a lot of activity happening within this area now.
Got it. And if I heard it correctly, on the agro side, you're saying you're working on 3 products, one of which has started and one you're saying...
One is under final qualification running at the customer. One is ready with us. We are asked to make the supplies in first week of January. So this will go into final qualification. And third product is approved on pilot scale. We are waiting for the necessary equipment. It requires a special equipment to produce it on a commercial scale. So this equipment we expect to be delivered within November, within this month. And then we will produce on a commercial scale and supply the qualification material. So all these 3 products we expect commercialization to happen from June of next year, between April and June of next year.
Okay. So at various levels of sizes, all the 3 will be in the revenue generation space from June 2024 is what you're saying?
June 24, yes.
And on a steady state basis, on a full year, what kind of revenue potential these 3 products have for us?
So basically we have 3 agro products and 3 pharma products. So from our existing revenue, we expect nearly 200% growth at least to happen, and at a full life and a full volumes, this can go up to 300 to 350% of growth in this segment, just with these 6 new product introductions.
And 6 means 3 in agro and 3 in pharma, basically, you're saying?
3 in agro, 3 in pharma, yeah.
Okay. So 200 and 300. And how much time you sort of visualize to achieve these potentials?
So 2026 is when FY 2026 we should hit the full potential.
Got it.
Because first year, even we don't want to move very aggressively because it's going to be our first attempt to that kind of a commercialization. These are all varied technologies by which these are being produced, which we have never done historically. And we have not handled products at such large volumes in multiple stages chemistry. Variety of chemistries are involved in each of these products. So even we want to move slow, and of course customer is not going to impart with all their volumes at one go. So they will also time and test us in terms of how consistent and in terms of delivery and quality we remain. And we expect that 25 will be a learning curve for us as well as for the customer, building up that confidence. And once we deliver, let us say 30 to 40% of potential in this next financial year, then FY26 would take us to the fuller potential of these products.
Got it. And as far as the headcount increase is concerned, is it related to these 6 products and the other things that you talked about, or there is more headcount that can come?
Theoretically, you can say yes, because see, we basically commercialize the facility, the new expansion. So to run that plant, you need manpower. So that is what has caused the increase in headcount.
But by and large, the heavy lifting on the employee addition is done this year and will be.
No, addition is already there in place. So there are people. So when we are doing all this validation production as well, you need manpower to run this new facility.
Got it. Thanks a lot, sir.
And that is what is causing an very disproportionate cost in terms of manpower. So if I see my numbers of this particular quarter, then my employee cost is contributing nearly 15% of the overall revenue, right? Which is disproportionately higher compared to your normal values of being between 6 to 8%. So this will also get normalized in next financial year when you hit the required volumes.
Okay. And your R&D also will normalize? Since in a sense the revenues will come and maybe the R&D might not grow at that rate.
So whatever new we are doing or whatever new we will do in future is only going to come out of R&D. So that I don't consider R&D expenses as an expense, because without this we are not going to grow ever. So I would not say this is an expense. I would say this is practically an investment that we are making.
Got it. And the capacities to generate these revenues they will
are
be
in place.
In place
Now so with minor bottleneckings, 30-40 crores of expenses in terms of debottlenecking certain things, that is what we foresee over next 6 to 8 months time. But once that is done, then we are ready for going to a 100% growth level within this new facility.
Okay, great, sir. Thanks a lot, and we look forward to these things materializing for us, and I look forward to that. Thank you.
Thank you.
Thank you. The next question is from the line of Nirali Gopani from Unique PMS. Please go ahead.
Yeah, hi. Thank you for the opportunity. Sir, so your commentary on SDA for next year is very, very encouraging. But to understand PTC and pharma and agrochemical a bit in detail for this quarter, so we have seen quite some decline on a YOY basis. And you mentioned in your opening commentary few of the reasons. If you can elaborate on the same. Because when you say that you have maintained your customers, so is it only competition from China that has impacted us, or there's a general slowdown in the demand?
First, let us talk about the pharma and agro and specialty. So this particular product category has 3 different versions, pharma, agro, intermediates, and specialty chemicals. On the agro intermediate side, we don't see any terms of challenges in terms of demand, except for our large product where we are supplying this to a customer was in a shutdown for 4 weeks. So that is where we had absolutely zero demand for 4 weeks during the quarter, which reflected in lower revenues during that this particular quarter in the pharma and agro side. The real impact in that category is coming from the other specialty chemicals, where a lot of catalyst and products we are supplying into polymer industry. So this continues to remain impacted since last 2 or 3 quarters, and prices have been declining very sharply. So not only it's not impacting the margins, but pricing per se in terms of raw material prices have dropped by more than 50% in most of the cases, which is involving this polymer application catalyst. So on that segment, I am not worried at all. The segment which is actually under pressure is the PTC segment. In terms of demand, yes, because all the product postponements that we have seen is only and only coming from this particular segment on the PTCs. Now, where the applications of PTC is happening is pharma and agro intermediates is our largest customer base when we talk of PTC. And this is where we have taken the most hit in terms of demand for the PTC. Fortunately, we have not seen any order cancellations happening. It's pure potentially, I believe that it is a good relationship that we share with the customer, which has led to postponement. But the postponement of deliveries had led to a lot of cost, because there are few containers which are already on the water or which have already landed in the foreign territory or the foreign ports. And now the customer wants to delay the delivery, which leads for us to, pick up this container, put it into a storage somewhere within that foreign territory, and which leads to a lot of damage accruals and stuff like that. And this is what we are managing this situation since last 3 months. And again, we are in the same spot for this quarter as well. So there are about 7 containers on ports or in water, which now needs to be delivered in January, February, March. So this is one challenging time, but the good part is we have not lost a single customer despite of whatever challenges have come through. Margins have remained fairly intact. The biggest challenge that we are seeing is in the domestic area in terms of PTC, where we have a lot of Chinese product coming in. We have a lot of local competition as well here. And unfortunately, the market is very price sensitive. So here, the value of having a good catalyst is not as important as having a good value or a good price. So to keep up in this domestic area is what is turning out to be quite challenging. So we definitely lost a lot of volume of PTCs within the domestic area. And also the erosion in terms of margin in the domestic market has been significantly high in the PTC. So of course, I see PTC is quite challenging within the domestic area, but as far as exports are concerned, I am not really worried on that part, because we have proven and we have established contracts with this customer. Even we have started building up new contracts for the next calendar year FY24. So 2 of our large customers have already contracted the volumes for the next calendar year with us. So in terms of consistency of business in the export market, we are absolutely in a good shape. The challenges are arising from the domestic market. So among all the segments that we are into, I believe PTC is the only segment where we potentially see a challenge in terms of competition only by way of pricing, in the domestic market. Whereas the other segments, because of very strong entry barriers, lengthy procedures in terms of qualification, very expensive qualification processes, which has helped us to retain our customers and also help us to retain the market share and the margins in the other product categories.
Right. For the detailed answer. In the gross margin trend, we have seen significant improvement. This is one of the highest that we have seen in the many quarters now.
Sorry, please, it's not clear. Can you please repeat it?
No, I was just talking about the gross margin. We have seen significant improvement there. This is one of the highest we have seen in few quarters. And given your commentary on maintaining an EBITDA of 100 crores for the full year, so do you feel this number is sustainable, the gross margin, because you have seen good improvement there?
As you know, the more volume, so really the margins will be visible from next financial year when your plant occupancy goes to its peak. As I told you, at these volumes we are seeing nearly 15% employee cost, which is absolutely unrealistic. So this starts getting realistic when your volumes and revenues start to build up. So what I am expecting is Q4 is to be a handsome quarter among all the 4 quarters of this financial year. So Q4 we are expecting very decent growth, and from next financial year I am super optimistic about the way we are going to grow.
Perfect. So largely to summarize, you see that FY24 should be the bottom year when we say consolidation revenue wise, and we will be obviously reaching 100 crores of EBITDA, which we had seen in FY22. So FY25 should look very different, and we should be on the normal growth trajectory from there.
Yes, that is what I am confident on. So all these product development, qualification, validations that have already happened during this year is going to show us the fruits in the next financial year.
Great, sir. Thank you for the opportunity.
Thank you.
Thank you. We take the next question from the line of Mr. Sanjesh Jain. Please go ahead, sir.
Yeah, good evening, Chintan. Good evening. First question on the auto side. If you look at BSF release, which in this week, the segment where they are most bullish is auto segment. I think inventory is also done because heavy metal prices, which is the other component in the emission which goes, there has been a steep fall, and that I think is now stabilizing. And that is one bright segment they look in terms of volume growth. Are you seeing, or is that the same thing which they're talking with you, and how does it help us in reviving the SDA segment?
So generally speaking, not only one particular company, but that is what I just talked on one of the prior questions. Is generally we feel that the life is coming back within this product category. So SDA is where now there's a lot of chatter happening, a lot of email exchanges have started happening within this particular product category. So life is coming back, people are seeing renewed interest, volumes are steadily picking up. And so despite of you see, overall the year has been really challenging for the chemical industry. And the volumes for us in the terms of SDAs have started to pick up. And this pickup is only from my customer number 1 and newly added customer number 4. Yet customer number 2 has still not revived at all. And customer 3 has now started reviving slowly. So it shows that this segment has now started to build up again back. So probably that de-inventorization activities are now almost through. People are wanting more products, regularly putting up inquiries. So yeah, I think what the large industries are saying in terms of de-inventorization has completed is now I feel that it is reality. So we see a good growth in this sector coming back.
Got it. And second, on the revenue side, it appears to be very soft. Can you help us? What was the volume and pricing mix? It's more of a factor of pricing. How is the volume trending for us?
See, except for PTCs, we have not seen any significant price movements in. I may point out 1 or 2 specific products, but generally speaking, except for PTC, we have not seen any kind of major price movements in any of the other product categories, any of the 3 other product categories. So our SDAs continue to remain almost at same levels. Of course, the price changes slightly with changes in raw materials, but it is not a very significant change. Whereas in terms of PTCs, we have seen price movements ranging to 20, 25 in cases. In large products, it has even gone down by 30%. So, but besides PTCs, I cannot really say that there's any major impact in terms of price. So volumes are reflecting what volumes were years back. So maybe with 5-10% price changes here or there is not really significant to talk about.
Got it. Got it. And on the PASC segment,
So of course, when we go to a backward integrated product passing on certain benefits to customer is when we will see some price reduction happening there, because we will have a significant saving in terms of saving cost for the customer as well. So we will pass on these benefits to the customer. So we will see some drop in prices happening, but that would in fact logically speaking, that would push my
margins and
margins a little bit higher. Yes. Yeah.
Got it. On the margin this quarter, gross profit margin, which is your revenue minus cost of goods sold, it has gone up very sharply to 61%. We used to be in the range of 50%.
There is one key factor to that.
Okay.
Is see, we have hardly used any inventory which is lying from the old inventory, because those products have still not started to move. So whatever is there, which has not moved. So high value inventory, we have hardly consumed anything. Maybe 5 or 6 crores of that inventory is what we consumed. But the rest of the inventories is what we bought within the last 4 or 5 months is what is consumed during this quarter. And this all has come at a significantly lower prices. So yet I am to pass on the benefit to the customer is to happen from this quarter. So the Q2 has given us some benefit in terms of low raw material cost and selling the finished product at almost the same price levels as earlier. So that is some, I would say, disproportionate gain in few of the products. Also, the product mix has slightly moved in our benefit. So there are 3 products which I could identify today. These 3 products we had significantly higher volumes that happened during this quarter. And these 3 products are best products for us in terms of margin. So one is coming from the SDA side, and 2 are coming from the PASC side. So one is an agro intermediate and one is a specialty chemical. So these 3 products actually moved to a larger volumes, which gave us an unexpected margins coming for the overall quarter.
Last question, I think we are running out of time, is on the other product like monoglyne, our rare earth chemicals. Where are we on all those?
So rare earth chemical extraction products we supplied during this quarter. So that supply has happened. We are waiting for my customers approval now. So we are looking at a good next year. So beginning from January 2024, we are expecting very good volumes to begin for that rare earth metal extraction products. Monoglyne, the continuous flow piloting is going on smoothly, of course, with few hiccups here and there in terms of separation and that. So, but overall, the plant is running very successfully. So we have already kicked off designing of a plant scale equipment based on whatever data has now been accumulated. So we expect this new plant scale production to begin probably in next 12 months time frame.
Got it. And that will be our first continuous flow.
That will, yeah. And the moment monoglynes comes out of this piloting, we have 2 products already waiting in queue for that pilot equipment.
Got it, Chintan. Thanks for answering all my questions and best of luck for the coming quarters.
Thank you, sir. The next question is from the line of Mr. Krishan Parwani from JM Financial. Please go ahead.
Yeah, hi, Chintan ji. Thank you for taking my question. Just a couple of questions. So I didn't hear what is the overall top line growth that you mentioned in FY25?
Anywhere between 70 to 100%.
Understood. So on that, just wanted to check, like, do you have any, like, let's say POs in place, because there could be, continued demand slowdown scenario?
It is not about POs. So except for PTCs, usually we don't have POs, and that too only large customers of PTCs. Otherwise, it is purely on forecast. So And see, basically you are investing something in some equipment, specialized equipment for a customer. It is based on some commitment from their side. So it may not be a documentary commitment, it may be a moral commitment. So that is how the things are working out.
Understood. And just the last bit on that front. So from which quarter do you expect to see a step jump in revenues?
From June of 24.
Understood. Well, thank you so much for patiently answering my question and wish you a happy Diwali in advance.
Thank you. Same to you.
Yeah.
We take the next question from the line of Mr. Yash Shah from Investec India. Please go ahead, sir.
Hi, sir. Thank you for the opportunity. Sir, my first question was regarding this quarter's, again, the gross margins. You just hopped that we were able to sell higher volumes of the higher margin product, and also we consumed very less of the higher cost inventory. Does it mean for the rest of the year or even in FY25, when the higher cost inventory will be consumed, at that point of time, our gross margins could be under pressure? Just wanted some clarification on that end first.
Now, practically, we are sitting on that inventory pre-March to a tune of about 24 crores, 24 to 26 crores. I'm not exact on that number, but anywhere in that range. So we have consumed almost 75% of that old inventory. Let us say anywhere between 70 to 75%. So now that impact will be there in any particular quarter where we use that inventory, but it's not going to be very significant.
Okay, got it, sir. Sir,
still, if I put it very simply in a layman's language, because I am not an accounts or finance guy, but if I put it very simply, I would say I am looking at potentially to absorb a loss of about 7 to 8 crores from this inventory. This is what I am expecting to happen. But it may happen in one quarter, it may spread over 3 quarters. It's just about, because now these are some of the products which we have not produced in last 3 or 4 months. So when this particular product comes up, its inventory gets consumed, that quarter we will get some hit. So it may not happen at one go, it may happen in multiple quarters. That is a strong possibility.
That's really helpful, sir. Yeah. So the second question which I had was, you guided on the FY25 growth, which could be somewhere between 70 to 100%. And so also you guided that SDAs would also grow around the same range. That would mean SDA's contribution would slightly increase as compared to the other segment, which is also the higher margin segment. So would it be fair to assume that on a base of 100 crores, which we are expecting to do in FY24, the EBITDA will also increase more than 70 to 100% as the SDA's contribution will increase?
Ideally, yes.
Okay. And any broad numbers, sir, could you have in mind, just on the basis of the trends which you are witnessing in the different segments? Any broad numbers would you have in mind of what the mix would look like by the end of FY25 or 26 across the segments?
Roughly about 30%, between 30 to 35% coming from SDA, about 40 to 45% coming from EASC segment, and about 3 to 4% coming from electrolyte salts at the increased revenue levels I am saying.
Perfect, sir. Thank you for answering all my questions, and happy Diwali, sir.
Same to you. Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to Mr. Chintan Shah for closing comments.
Thank you. On behalf of management of Tatva Chintan, firstly, thank you all for joining us on the earnings call today and wishing you all a very happy Diwali and Saal Mubarak in advance. We hope we have been able to address majority of your queries. You may reach out to our CFO, Mr. Ashok Bothra,
or our investor relationship partner, Ernst & Young, for any further queries that you may have, and they would connect with you offline. Thank you, Mr. Sanjesh, for hosting our call. Once again, thank you all and a happy Diwali.
Thank you, sir. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect.